The stock market continues to swing wildly in both directions. And while we are not in an official recession at this time, all of the major stock indexes are flirting with bear market territory. Now, this is generally not a big problem for dividend cash flow investors. The truth of the matter is, though, I've gotten a lot of questions and concerns, frankly, about the overall health and safety of covered call ETFs, such as QYLD, RYLD, and XYLD. The biggest concern has been with QYLD, with its stock price dropping below $18 per share lately. In this video, we're going to look at how the three main GlobalX covered call ETFs have performed against the major indexes that they track. I'll share with you my own thoughts about QYLD dropping below $18 per share, and we'll talk about any conclusions we can draw from the results we look at. Naturally, I built a spreadsheet to document all of the results for QYLD, XYLD, and RYLD, and we will differentiate between the results if we reinvest all of our dividends versus just living off our dividends and only having the price history alone. Now, just to make sure we're all on the same page, we have three major covered call ETFs we're talking about: QYLD, XYLD, and RYLD. QYLD is the NASDAQ 100 covered call ETF, and this tracks the NASDAQ 100. The most popular ETF that we can compare it against is QQQ. Then we have XYLD, which is the same as QYLD except it tracks the S&P 500, and we're going to compare that against SPY, the most popular S&P 500 ETF. And then we have RYLD, which is the same as the other two except it tracks the Russell 2000, which is primarily small cap stocks. The ETF we're going to compare it against is from iShares, the IWM ETF. Specifically, we're going to take a look year to date from January 1st through present here, mid to late May, to see what are the results if we just started investing in January of this year, which the whole goal of this is to look at how do these indexes track in a recession. That was the big thing we're looking at. I know that not everyone bought in January and that we have a much longer view we could look at, but we're just trying to isolate the recession to see dollar for dollar how do these two investments compare. As a quick reminder to you guys, the spreadsheet we're looking at in this video and all of the spreadsheets I do and all of my videos are available if you join the Patreon community. We are a select group of dividend cash flow investors that are all working together, learning from each other so that we can obtain financial freedom through dividend investing. In addition to all my spreadsheets, you have access to my monthly dividend stock spreadsheet and a private Discord community where we all get to communicate, and you can also track all the moves that I make in my own dividend portfolio. If you're interested, check out the link down in the description below. All right, so first we're going to look at QYLD compared to QQQ. Now, QQQ is in yellow, QYLD is in light blue here. You'll notice that if we start with $100,000, which again, I don't expect you all to have $100,000, it's just a round number that we can start with for both investments starting on January 3rd, which was the first trading day of 2022. It's very plain to say that if we're just looking at price history, okay, we're not reinvesting any dividends, it's just the actual price of QYLD and the actual price of QQQ, we can see that QYLD had less volatility and was worth more from January 1st through May 16th, 2022. Specifically, QYLD would be worth around $79,542. whereas QQQ would be worth approximately $71,868. However, we're not reinvesting dividends yet, so we know that QYLD has significant cash flow. Let's go ahead and incorporate that and see what the results change. All right, so we've got a third line here. This is the dark blue line, which is QYLD with reinvested dividends. We can see that that has outperformed QYLD without reinvesting and QQQ. So instead of 79 versus 71, now we have $83,000 versus $71,000. So for QYLD specifically, we can say that dollar for dollar, it has less volatility than QQQ, and it had a smaller drawdown on our overall assets. Now we know that historically, QQQ has outperformed QYLD over the long term, and when the markets are going up, QQQ vastly outperforms. But what we can say is in a downturn here, and we've had almost 5 full months to look at, QYLD is outperforming QQQ. Let's go ahead and move on to XYLD compared to SPY. All right, first we're looking at XYLD, just the price history compared to SPY, the S&P 500 price history, starting with $100,000 each. And we see very similar results that we saw with QYLD, where XYLD is outperforming the S&P 500. It's just, there's less volatility here. We started with $100,000. SPY ended with $81,562, whereas XYLD had $86,423. Now, when we factor in reinvested dividends, we even have better performance from XYLD. Instead of 86 versus 81, Now we're up here at $90,000, just under $91,000 compared to $81,000 down here. These investments very closely track each other, but there's just less volatility with XYLD than we have with the S&P 500. Even putting aside the cash flow we're getting, the massive cash flow, we are still able to outperform and have lower volatility with these covered call ETFs compared to the overall index. And again, we know in a bull market that these investments, the S&P 500 and QQQ, they outperform the covered call ETFs on a total return perspective. But that's not why we own these investments, and we'll come back to that in just a second. All right, lastly, let's take a look here at RYLD versus the Russell 2000, which is the ETF IWM from iShares. Again, starting with $100,000 here. Light green is RYLD, and yellow is the Russell 2000 ETF. Same idea, less volatility, higher overall portfolio value. We started with $100,000 and we dropped all the way down here to $78,146, whereas we end up with $85,000 with RYLD without even reinvesting any of the dividends, without the option premium being included. Now when we include reinvested dividends here, the portfolio balance for RYLD, reinvesting all dividends, outperforms the other two investments here. Instead of ending up with $85,000, we end up here with $89,839 as compared to IWM worth only $78,000. So we can see that all three of these covered call ETFs in a prolonged downturn in the economy, outperforming, aka lower volatility, than the S&P 500, than the Russell 2000, and better than the NASDAQ 100. Now to address QYLD specifically, I've got, like I said, a lot of concern from people. You know, when QYLD launched, it was right around $24, $25 a share, and it dipped down. Everyone is aware, or at least everyone who watches my channel, is aware of the fact that QYLD, over the long term, slowly loses value. If you look at QYLD compared to QQQ, and you actually look, starting right around here in 2016, these investments really are rising and falling with each other. They both are rising during this period from 2016 all the way up here. There's a drop in 2018 down to 2019. Very similar. They both climb all the way through COVID. Then there's a massive COVID drop in both investments. They climb back up and then they drop back down. Now they do it to varying extents. QYLD obviously is not tracking QQQ dollar for dollar. QQQ is vastly outperforming during this time frame. However, they are rising and falling together at the same time based on market conditions. However, there is a uniqueness to it. I isolated this time frame here from 2013 December all the way through 2016 for both investments. You can see for the most part here that QQQ rose pretty steadily. There was some volatility up here, but for the most part, it started down here. Over the entire period, it started at $86 per share, ended up at $108 for a total return of 26.67% over the entire period. However, if we look at QYLD, over that same time frame here, it started right up here at 25 when it first launched, and it ended up down here at 21. So instead of gaining 26%, it lost 13%. And the only thing I can really attribute that to is QYLD was launched, it originated at a price much higher than its fair market value. I feel like that fair market value should have been more like $22 per share, give or take, which is where it kind of landed before it started to rise and fall directly with QQQ. Now since then, of course, we know it's gone up to as high as almost 25 again here, 24 and change, 20 right around here, and then it dropped again as far as when we had a pretty significant pullback, drop from 25 down to $21 a share, then it rose back up here, and then pre-COVID it was at 24, dropped way down here to $18.23 per share, climbed back up out of COVID to 22, give or take, actually up to 23.46, and then most recently, in alignment with QQQ, has dropped significantly, but at a new low that we have not seen before, down below $18 per share. So what's my take here? Well, I think it's just a reality of the fact that QYLD will never make new highs, in my humble opinion, based on just its price per share, and it will continue to eventually, over time, make new lows. And it will still oscillate a little bit right around between $19 and $22, $23 per share over the foreseeable future. Over time, though, I think over the long term, it will drop below 17 down to 16 and 15. Whether that takes 5 years to do or 15 years to know, I don't have a crystal ball. But I think that's just the reality of QYLD, which brings us to why do we own this investment? If you're concerned, that tells me that the way you're investing in QYLD is not in alignment with the best way to use the investment. To be clear here, QYLD is best utilized when you are using the cash flow to live on right now. A secondary way to use it would be to actually utilize the cash flow as a portion, a segment of a high yield dividend portfolio. That's the way that I use it, but it makes up a very small percentage of the portfolio, less than 3 or 4%. Now, the truth of the matter is there are some people out there, there's quite a few of them actually, that are dumping tons of money every month into QYLD and reinvesting the dividends. Are you doomed in this investment scenario? I don't think so. In fact, you might be successful, but you're not utilizing QYLD in the best way possible. What we've seen here across all 3 different major indexes and all 3 covered call ETFs from GlobalX, there's less volatility, less of a drawdown with these investments, and ultimately at the end of the day, better performance. In the next video, guys, we're going to take a look at all of the different covered call ETFs out there, not just the ones from QYLD, RYLD, and XYLD. We'll look at JEPI, we'll look at NUSI, we'll look at QRMI, XRMI, we'll look at DGRO, we'll look at DIVO, and everything in between to see which of these covered call ETFs has performed the best in this recessionary environment. Make sure to leave your 2 cents down in the comments below. I respond to all comments left on the day I post a video. That's all I got for you guys in this video. Have a great rest of your day, and please continue to stay healthy, both physically and financially. Have a good one.